Yeah, the thinking out there is that perhaps as far as what we've seen this week, it is easier to help the stock market than the real estate market. I suppose we need to see that translating into the real economy as well. So no doubt it's a positive sort of feedback loop, but I'm curious to get your thoughts on whether you believe that the stock market can rally meaningfully without a tangible pickup in the property sector.
Yes, that's very correct. And I think if we look at the economy and what's been driving the growth of the economy so far this year, and for most part of last year, it has been a very strong export growth, and it has been infrastructure and capital investment led by the government and some of the SOE companies. We need the enthusiasm from the private sector, including the consumers, including the private corporates, to actually come on board. And for that to take place, we need to build better confidence in the future outlook of the economy. This goes back to my earlier point about if all the measures announced so far can be effective enough to break the debt and deflation loop so far we've been experiencing. So as I emphasized earlier, we need to see more details, and I think timing and the swiftness is very, very critical at this point. We are going into the National Day holiday in less than a week, and then there will be a week of break for onshore trading. After the break, we would really like to see as soon as possible the execution details on the fiscal spending and on the market stabilization measures. Sure. And I think the next policy event that we can pay close attention to would be towards the end of October, where we could potentially have a NPC standing committee meeting. We would like to see if there could be a fiscal deficit expansion occurring at that event.
Laura, what we're seeing in the market is a rebound. Would you call it a dead cat bounce or a structural reversal?
For now, I think this is a tactical rebound and a technical rebound. As I said, the re-lending program is making it very clear. You can borrow at 2.25%, and if you are paying dividend yield higher than that, or if you have the capacity to pay dividend yield higher than that, it makes perfect sense for you as a listed company to borrow from it and buy back your own shares. And beyond this point, we need the earnings growth to re-accelerate. We actually have a quite cautious view on the earnings growth for both this year and next year, assuming no further fiscal spending will take place. And market consensus is actually looking for extremely high earnings growth for this year and next year. This is why, up until recently, we have been much more cautious versus the market consensus. For the earnings growth to come along, we need to see real demand growing again. I think the next few weeks will be extremely important for us to monitor the travel, the spending, and the housing sales data after the National Day holiday, and also to see what the government decides to do in terms of stepping up their support for stabilizing the housing prices, to empower the employment situation, particularly for the young generation. And as they promised that they want to do more counter-cyclical fiscal and monetary spending. All of these need to take place very, very quickly in the coming weeks or in a couple of months to make this more sustainable into a real recovery rally.